Stocks, mutual funds, ETFs. You hear these terms everywhere, but what do they actually mean? And more importantly, which one is the smartest choice for you? Today, I'll break it down in the simplest way possible, so by the end of this video, you'll never confuse them again. Let's dive into stocks. When you buy a stock, you're actually buying a small piece of a company. This is called a share. Imagine holding a certificate that says you own part of a business. Stocks are bought and sold on stock exchanges, like the New York Stock Exchange or NASDAQ. Picture a bustling trading floor, or people buying and selling shares online with a click. As a shareholder, you might get dividends. These are payments companies sometimes give to their owners from profits. Plus, you often get voting rights in big company decisions, like electing the board of directors. The value of your stock goes up and down with the company's performance and the overall market. If the company does well, your shares can become more valuable. If it struggles, your investment can shrink. Think of stocks like owning a ticket in a company's journey. If the company becomes the next Apple or Tesla, you could see huge rewards. But if it fails, you could lose your money. It's high risk, high reward, like betting on a racehorse. But you get a say in the race. Let's dive deeper into mutual funds. Imagine a big pot where thousands of people pool their money together. This pot is then used to buy a variety of investments, like stocks, bonds, or both. This pot is managed by a professional called a fund manager. Their job is to decide which investments to buy or sell, aiming to grow the value of the fund. There are different types of mutual funds. Equity funds invest mainly in stocks, debt funds invest in bonds, and hybrid funds mix both. Each type has its own risk and reward. The value of your investment is tracked by something called NAV, or net asset value. NAV is calculated by taking the total value of all assets in the fund, subtracting any liabilities, and dividing by the number of units. Sometimes, there are extra costs called entry loads when you buy in, and exit loads when you sell early. These are like small fees for joining or leaving the fund. Pros: you get instant diversification. Your money is spread across many companies or bonds, reducing risk. Plus, a professional is making the decisions for you. Cons: you pay management fees, which can eat into your returns. And you don't get to pick the exact investments. You're trusting the fund manager's choices. Think of mutual funds like hiring a chef to prepare a buffet. You pay a fee. You don't choose every ingredient, but you get a balanced meal with less effort and more variety. Now, let's dive into ETFs, exchange-traded funds. Imagine a basket filled with different stocks, bonds, or assets, all bundled together and traded on the stock exchange just like a regular stock. Unlike mutual funds, which are priced just once at the end of the day, ETFs can be bought and sold throughout the trading day. This means you can react instantly to market changes, just like with individual stocks. Here's a key difference. Most ETFs are passively managed, tracking an index like the S&P 500 or Nifty 50, while mutual funds are often actively managed by professionals. This usually means lower fees for ETFs. Let's talk about expense ratios. ETFs usually have lower expense ratios than mutual funds, meaning you keep more of your returns. For example, many popular ETFs charge less than 0.1% per year. Another important concept is liquidity. Since ETFs are traded on exchanges, you can buy or sell them easily during market hours. But always check the trading volume. Some niche ETFs may be less liquid. There's also something called tracking error. This is the small difference between the ETF's performance and the index it follows. Lower tracking error means the ETF closely matches its benchmark. For example, SPY is a popular ETF that tracks the S&P 500 in the US, while Nifty Bees tracks the Nifty 50 in India. There are ETFs for almost every sector, country, or theme you can imagine. So think of ETFs as a DIY meal kit. You get a pre-packed box of ingredients, you know exactly what's inside, and you can cook it up whenever you want. Quick, flexible, and cost-effective. Here's the simplest breakdown. Stocks: one company. High risk, high reward. Mutual funds: many companies managed. Safer but higher fees. ETFs: many companies automated. Safe plus cheap, flexible. If you want control and are ready for risk, stocks. If you want professional management, mutual funds. If you want diversification plus low cost, ETFs. And that's it. The simplest breakdown of stocks, mutual funds, and ETFs. The best option depends on your goals, growth, safety, or flexibility. So which one fits your investing style? Tell me in the comments below. And if you found this helpful, hit that like button, subscribe for more, and check out my other videos on investing basics.